In a bid to safeguard investors' interest, market regulator Sebi has proposed to tweak rules governing IPOs to bring in more transparency and accountability. The regulator recently issued a consultation paper in this regard and has sought feedback before the end of this month. The notable changes include a cap on the amount companies, mainly startups, can raise for inorganic growth initiatives, and also on the quantum existing shareholders can offload in the IPO. Further, Sebi has proposed to increase the lock-in period for anchor investors from 30 days to 90 days. It has also called for the monitoring of IPO proceeds. The proposed tightening of IPO funding comes amidst a gale of public offers, which is likely to see a record mop-up of 1 trillion rupees this year. Besides, a bulk of this money was raised by new age and loss-making tech-based startups including Paytm, Policybazaar and Zomato. Let's go to Amrish Balika, an independent market expert, to understand why Sebi proposed such changes and what it means for investors.
It's good that Sebi has recognized the problem areas. Most of the recent IPOs are actually offer for sale. The fresh raise has been negligible except possibly for Paytm. In case of new age companies, it's basically handing over the baby to the public by early investors and promoters. Such a sale, I think, should be capped at 50% irrespective of the promoter holding, as these companies need cash for their growth. However, the interests of the selling shareholders seem paramount in the IPO, as everybody is looking to encash the bullish sentiments in the secondary markets. Let me take the example of Nykaa. It was a 5,300 crore issue. Only 630 crores was raised for the company. Balance was sale by PE investors as well as promoters. Just after the issue, promoters pledged about 4,000 crores worth of equity to possibly raise 2,000 crores, mostly for the cash requirement of the company. Couldn't this have actually been raised in the IPO? Regarding acquisition funding, it may not always be possible to identify the specific takeover target, but my suggestion would be to keep that in an escrow account, monitored by an agency so that it is not used up for cash burn. The other suggestion was on the anchor category. It seems they are anchors only by the name. It's basically a route to short circuit the IPO. I would suggest that the anchor category itself should be removed. If not, the holding period should be increased to 6 months, as many have been misusing this to make a quick buck. Coming to the general corporate purpose category, this has been the most misused part of the IPO. Some of the IPOs, the portion allocated for fresh sale of equity has been mostly been general corporate purpose. Basically, this means that you can use the funds for anything you like. And what I understand is that many a times these funds get used for post-IPO market making activities. It's good that SEBI is proposing to monitor this very closely.
While the proposals are yet to be adopted, industry players feel changes around anchor investors and cap on OFS quantum could come across as extremely unpalatable and may have a cascading effect on the Indian capital markets going forward. Given this, it remains to be seen what the market watchdog will decide after receiving stakeholders' feedback. In a separate development, equity investors received a nasty surprise from global rating agency Fitch Ratings. On 16th of November, the agency maintained India's ratings at the lowest investment grade of BBB- or BBB- with a negative outlook on account of high debt and limited fiscal headroom. This comes after Moody's Investors Service recently upgraded its investment outlook to stable from negative. However, economists believe since India is probably going to be one of the best performing economies in the world this year, investors should focus on the country's reform agenda. We spoke to Madan Sabnavis, who is chief economist at Care Ratings, for a detailed analysis.
India should be ideally in the grade of at least A, but currently we are still kept at BBB-, which is the lowest investment grade. But the outlook is something which came as a surprise because the other two rating agencies have taken a stable outlook for India, but since rating is a very subjective opinion being given by agencies, Fitch has evidently felt that the outlook should be negative. Now, the main concern which Fitch has mentioned in their arguments is that the fiscal situation still appears to be fragile. Now, while India's fiscal deficit is definitely higher and the debt levels are higher than the median of the comparable countries, it should be remembered that the government has been very prudent even during the pandemic times. And while a number of Western economies have actually gone in for a fiscal stimulus by giving tax breaks and cash transfers, this was done to a very limited extent by the government of India. So I think the entire way in which we tackled the pandemic was keeping the fiscal numbers in mind. And this was where even certain domestic critics felt that the government should have been a bit more aggressive. Now, surprisingly, while Moody's and S&P have actually appreciated the fact that we did not go in for such freebies during those difficult times, Fitch has obviously taken a different view on it. But we are hopeful that in future, as the economy grows and the fiscal ratios look much better, which are bound to happen as our GDP grows, and India is probably going to grow at one of the highest rates in 21-22, there will be a good reason for Fitch to reconsider their view on India's rating.
These developments, along with inflationary and valuation concerns, are likely to keep the markets volatile in days ahead. Yesterday, the BSE Sensex fell 314 points to close at 60,008. The Nifty 52 shed 100 points and ended at 17,899. Trading volume in the secondary market, however, may remain thin today given a long weekend ahead. Further, all eyes will be on the listing of Paytm, which concluded India's biggest IPO last week. The grey market premium has fallen sharply over the past few days and was in the negative territory on Wednesday. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.